Most retirees are aware that you have basically two tax deadlines. There's the December 31st deadline, and then there's April 15th deadline. One represents the calendar year, the other represents the tax year. Today, we're going to cover the necessary things that you must complete before the calendar year deadline, December 31st, to make sure that you're able to maximize the taxable benefits that are available to you and also do your best to lower lifetime tax liability. If we've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. There are a couple of things that I think are new that we've discovered here in the tax year 2025, specifically as a result of the One Big Beautiful Bill that was passed on July 4th. However, there are some things that you want to be aware of that are going to remain the same for 2025 and likely moving forward. Let's make sure we cover those today. The first one that we want to cover are required minimum distributions. If you're not familiar with required minimum distributions, they are an amount that you are required to take each and every single year from a pre-tax retirement account. And this amount is determined by the year-end value of the prior year and your age. By calculating a required minimum distribution, you're able then to determine how much you need to take out in the next tax year. Now, keep in mind, if you have multiple IRAs, you can look to aggregate your required minimum distributions and take them from one source. Regardless, it's going to start either in the year in which you turn 73 or the year in which you turn 75 if you're not already collecting. If you were born pre-1960, it starts in the year in which you turn 73. If you were born after 1960, it starts in the year in which you turn 75. But that required minimum distribution you must take, and you must take it within the calendar year. There's one minor exception. That would be in the first year that you're required to take a required minimum distribution. You can wait until April 1st of the following year. However, you should proceed with caution if that's the case, because you're going to need to take two required minimum distributions then that next year. And that's going to be income that you'll have to report. So you want to be careful, if you can at all avoid that, to take it in each successive year rather than taking two in 1 year. Now, the penalty for not taking an RMD can be pretty significant. The amount is 25% of how much you should have been required to take out. So if your required minimum distribution is $10,000, the penalty that you could face if you don't take a required minimum distribution is $2,500. That's an amount that you don't want to have to take if you don't have to. So make sure that you have a plan in place to take the required minimum distribution and that you do so in a timely fashion. The next thing that you want to look into, and this applies for folks who have more non-qualified accounts, are either tax loss harvesting or tax gain harvesting. Again, this is going to apply to your non-qualified accounts. So if you have an IRA, Roth IRA, 401k, this likely isn't going to apply to any of those accounts. Instead, it's going to apply to your non-qualified brokerage accounts. And the way that this would work is that you can either sell off winners and losers to make sure that you're able to reset some of your cost basis, or potentially take advantage of a lower tax bracket that you could find yourself in. Now, let's first start with tax loss harvesting. Tax loss harvesting could be a great opportunity if you have losers within your portfolio, funds that are down, funds that have lost value, where your cost basis is actually higher than the value of the stock. If that's the case, you're going to have a loss on that fund or a loss on that security that you may be holding. You can offset that with some of the winners that you have in your account, which normally you would have to pay capital gains tax on. So for example, if you have two funds, one has lost $1,000, one has gained $1,000. If you were to sell both of them, you could offset the gains and losses, and that's reset your cost basis in both of those funds. Now, there's a tax side of this, but there's also the investment side of this. So you want to make sure that if you're going to be moving forward with this, that you do so in such a way that is going to cover both your investment goals and also your tax goals. Let's cover how tax gain harvesting works. And we shot a video on this not too long ago, which I'm going to link to right now. But in this video, it's going to show you how retirees, specifically ones who are either under $150,000 of modified adjusted gross income for married filing jointly filers, or under $75,000 for single filers, how you can really take advantage of some of the significant tax savings that are available to you. But when it comes to the capital gains bracket, you're going to have the standard deduction applied to it, along with a 0% bracket up to a certain amount for both single and married filing jointly filers. When you add on the additional enhanced senior deduction amount, again, that just adds more room to the 0% bracket. If you like more of a deep dive in how you can best maximize the 0% bracket, check out the link to the video for 2025. The next thing that you can look to take advantage of is Roth conversions. Now, Roth conversions and Roth contributions are two separate animals. Roth conversions, you need to make sure that you complete in the calendar year. You're not able to make a 2025 Roth conversion in 2026. You can make a Roth contribution in 2026, so long as you do so before the tax deadline. However, Roth conversions must be completed in the calendar year. Roth conversions are, again, where you take money from a pre-tax account, you pay the corresponding tax, and convert it to a Roth account. This can be a way, and we've talked about this ad nauseum on this channel, in which you can look to prepay some of the tax and prepay some of these funds now, as opposed to paying them later. You can do so at a known rate now, and it's best taken advantage of if you know you're going to be in a lower tax bracket today than you will be in the future. But you also want to make sure that you give yourself enough time for this to process. Depending on the custodian that you're working with, some of these can be done in the same day and it can be done rather quickly. Others, there might be a little bit more time to make sure this is completed. But make sure that you have a plan and you work with your tax advisor along with your financial planner to come up with a sound conversion amount, and then making sure that you properly execute this. One other note that's worth knowing is that Roth conversions are a move that are irrevocable. If you decide to complete a Roth conversion, you cannot recharacterize it later in the year. The Tax Cuts and Jobs Act of 2017 made Roth conversions irrevocable. So just make sure if you're going to make this move, that's one that you're certain of and that's one that you've planned for. That said, I think there's great timing for Roth conversions, which is typically done at the end of the year, because I think there's a good idea of how much you've actually made and how much room you have within certain brackets and to make sure that you don't cross certain tax thresholds. Another great time, though, is when the market's down. And I'm linking to another video right now that'll give you an idea of when you can consider Roth conversions, especially in down markets. Something else I think that's a good idea is to make sure that you have a gifting strategy down pat. And gifting strategies, I think, are one of those things that can be often misunderstood. For most folks, you might be familiar with the annual exclusion limit. In 2025, it's $19,000, and that's per donor and per beneficiary. So if you're looking to make a gift, you want to make sure you do so within the calendar year, but you can gift up to $19,000 per year per donor and per beneficiary, completely tax-free without any type of reporting. If you go beyond the $19,000, that's when you need to file a Form 709 with the IRS, and that would track how much you've gone in excess of the $19,000 or the annual gifting exclusion. Something, though, that I think is often misunderstood, it's not the end of the world if that's the case, especially if your net worth is well below $15 million. And the reason that is because that Form 709 only needs to be reported if you go over the annual gifting limit, but that Form 709 also tracks your lifetime gifts. Understand that you have up to $15 million of gifts beyond the $19,000 of the annual gifting exclusion. And that's what the Form 709 would help track. So if you gift more than $19,000, just understand you might need to report it, but you don't necessarily need to pay tax on it so long as you stay under the limit. Also keep in mind that this is something that you can do per donor and per beneficiary. So rather than giving one large gift to one individual person, you might be able to have a spouse write a separate check, and you could write it to the separate spouse. So in other words, if my wife and I were giving to my child and his or her spouse, what you can end up doing is making a $19,000 check per donor and per beneficiary. So understand that you don't necessarily need to just make one check out to one person. You can spread it out per donor and per beneficiary. Two other things that I think are worth looking into is making sure that you're aware of what the IRMAA tax brackets are. Now, the IRMAA tax brackets are something that are going to be 2 years forward looking. So you don't necessarily know what they are in 2027 just yet. And the 2025 income that you're going to report is going to affect your IRMAA brackets in 2027. But we now know what it will be in 2026. The brackets have just been released and you're seeing them here. So you can have an idea if you're over a certain amount and you made this in 2024, what your Medicare premiums will be in 2026. Be aware that any planning that you do, specifically Roth conversions, could cause an IRMAA bracket threshold to be push through, which would end up costing you a couple bucks more each month, 2 years forward looking. So planning ahead for that and making sure that you're aware of the implications of either making too much money or doing too large a Roth conversion, that could have an impact on your Medicare premiums 2 years forward looking. The next thing that I think is really important and you want to make sure that you've done a good job of is tracking your tax withholding. Now, we shot a video on this not too long ago as well about the different ways in which you can pay federal tax. One of them is you can have funds withheld. And this is commonly done via Social Security withholding, pension withholding, perhaps from an IRA distribution. If you've had funds withheld and you've made sure that the IRS has been covered throughout the year, you just want to make sure that you matched up how much you've made in a given year and how much you've prepaid. Assuming that that's the case, you're likely to hopefully have to pay a bare minimum amount to the IRS once you file next year. Ideally, you could break even or potentially even get a little bit of a return. But there's also quarterly payments that you can make. You just want to make sure that you've done a good job and tracked your records properly to make sure that you've covered how much is owed. By doing this, you can make sure that you avoid any type of penalties by staying below the safe harbor amount that the IRS requires. Assuming you've done that, you shouldn't have anything to worry about, but it's not a bad idea to make sure that you're checking this at the end of the year and making sure that 2025 has been covered as far as how much you owe from a federal standpoint. As I mentioned, I don't think it's a good idea to wait to the last minute. If you wait until the last week in December, many custodians will also be closed for Christmas and could be working limited hours. By making sure that you give yourself at least a couple of weeks to make sure that this is done properly, and more importantly, that it's actually processed, that way you can make sure that you've gotten it in before the deadline. After all, we all tend to procrastinate from time to time, but this is something that I think it's best to make sure that you get done with plenty of time. The last thing that I think you want to make sure that you get done is making sure that your charitable contributions are properly accounted for. This can take place in either a QCD, otherwise known as a qualified charitable distribution, setting up a donor advised fund, or donating appreciated securities. Each one of these things can lead to a significant tax savings, but you need to make sure you get them done before the deadline. For each of these, you can check out this video right here to have a better idea of what these mean and how to get them in on time to make sure that you're able to maximize your charitable gift and to save on taxes.